I didn't mention, our focus today is really going to be around small business accounting, right? Talking about books and records. And within that, we're going to cover a wide array of topics. But that's my information that is out there, Nana P. Agyekum CPA. My email address, and you can always get it from Demaris and John if you like that as well. And my website over here is www.agerassociates.com, and that is my phone number that I have on there. Next slide, please, John. So that was the introduction. Next slide, please, John. What I want to do is kind of give you a lay of the land, give an overview of some of the things that we're going to cover right now within this webinar. I know accounting can be a very daunting task, but as much as possible, I'm going to make this fun for you as possible. Right? A lot of people have been to these webinars, walk away feeling good about now doing books and records. I had somebody said I'm moving a bit fast, so I'm going to slow down quite a bit. So the first thing that we're going to cover is going to be, what are the three main financial statements, right? The reason why that is important is because usually when you go to the bank, and the banks are starting to ask for this, they do tell you that could your company produce financial statements? And most business owners are trying to figure out, okay, what do they mean by financial statements? So we're going to cover that. The next topic that we're going to cover is, what are books and records in a business context, and why are they important? And why is it important to set up charts and a chart of accounts correctly, right? And how to maintain accurate books and records, common financial mistakes small business owners make that may cause your business to fail, and common issues people are having with accounting software. So let's dive into it. So before we get into the three main financial statements, I just want to talk a bit about some of the words that you'll be hearing thrown around. People talk about assets, liabilities, right? I just want to say, what are assets and what are liabilities? If you hear somebody say, what is an asset? So basically, an asset is any item of economic value by an individual corporation, right? Which can be easily converted to cash. That's an asset, right? What is one of the basic examples of an asset? Inventory, fixed assets, cash and cash equivalents, accounts receivable, and even fixed assets, which is a computer, right? So that is something that is an economic value. So when you say economic value, what I really mean is that something that is of benefit to you, that you can really sell and get money in your pocket. That's what an asset is. What is a liability? It's the flip side of an asset, right? It's an obligation of an entity arising from past transactions, right? Now, what would you say? What is an example of a liability? Accounts payable, loans payable, credit card debt, rent payable. So that is a liability. And as we go through that, during the webinar, I'm just going to walk you through how all these are connected, right? Next slide, please. Now, people here, we talk about revenue and an expense. So what is a revenue? So in the business, revenue, is income that a company receives from its normal business activities. So that is very important, and I'm going to tell you why that is important, because people usually confuse revenue, right, with money that an owner is putting in the company, right? So what are examples of revenue? Sales revenue, fees, and commission. So let's say, let me just give an example. You're in the business of selling clothing, right? When you sell clothing and you earn money, that is your revenue, right? Because that is that is your normal part of your operation. However, the reason you do a transaction, you do sell your car, remember that if you do sell your car, even though it's going to be a business, maybe you use your car for business, because your car is not part of your normal, it's not part of your normal operation, that is not going to be considered revenue. So we're going to talk about that a bit more. Now, what is expense? It's money spent or cost incurred in an organization's effort to generate revenue, right? So, you have a company and you decide that, okay, I want to generate certain kind of revenue. I need to buy some materials. So you're going to spend the money to buy materials. And remember that those materials are going what you're going to use to sell to get revenue. So that's what an expense is, right? Now, when we talk about revenue and an expense, right, what is it known as, right, on a statement? Profit and loss or income statement. Now we're going to go through the three main criteria or the three main financial statements. Next slide, please, John. So now that you've had assets, liabilities, revenue, and expense, let's see how all that fit in together, right? So the three main financial statements are your balance sheet, your income statement, and your cash flow statement. Now I'm going to take my time over here just because I think this is very important that every business owner should understand, right? What is a balance sheet? So a balance sheet will have your assets, which you just spoke about, your liabilities, which you just spoke about, and something that we call your owner's equity, right? Owner's equity is usually money that a business owner has put into their company. So the math is your assets minus your liabilities should be equal to your owner's equity. Now let's flip this around, and we're going to go through that on the chart. Your assets must be equal to your liabilities plus your owner's equity. We're going to cover that in the subsequent slides, but just keep that in mind as we go through that. What is your income statement? So that income statement is either called profit and loss statement or revenue and expense statement. It's all the same. So if you go somewhere and the bank is like, can you give me your income statement? Is it statement of profit or loss or statement of revenue and expenses? And also the cash flow statement, which is very, very important, right? And we're going to explain that as well. Next slide, please. John? Now, let's talk about chart of accounts and why it's important to set it up correctly. I just want to talk about chart of accounts briefly so that we can be able to get into how the balance sheet and the income statement looks like. So basically, what a chart of account is how a company organizes their finances to give an interested party, such as a financial institution or shareholder, what is really in your company, right? So it's basically is when you have your asset, right? What are some of the line items on your asset? You have cash, it's a chart of account. Accounts receivable, it's a chart of account. Inventory, it's a chart of account, right? If you don't have inventory, you may not need to set up an inventory as part of your assets, right? So all these different line items within your financial statements is what we call a chart of account. And it's important that you set it up correctly. And I'm going to explain to you in the next subsequent slides why. Next slide, please, John.
Nana, I have a quick question. Are you saying that the chart of account is going to be different depending on what business and industry I'm in?
Yes. Yes, that's accurate, John. But remember that there are certain chart of accounts that across every business is going to have, like cash. Every business is going to have cash, right? But what about inventory? For instance, I don't have inventory on my chart of accounts because I'm in the business of providing, services. So what I get is revenue. So I'm never going to have inventory because I don't keep inventory. So that's right. There's certain chart of accounts that is not going to be necessary. That's why when you're setting up a chart of accounts, they usually ask you, what is your business? Right? Based on your business, you're going to have an idea what those chart of accounts that you need to set up that are very peculiar to your business.
I just
So
want to,
now,
really quickly, I just want to let everybody know that if you have questions, please put it in the chat. And if make sure the questions are relevant to what Nana is talking about right now. And then I will either stop and ask Nana for you or allow you to speak on the mic and let him answer you directly.
And Nana, this is Damaris. If you could just push your speaker away a little bit from your mouth, it just sounds a little bit muffled. And I'm a little hard of hearing.
Okay?
Yeah, perfect.
That's much better.
We like your voice.
Okay.
Thank you.
Great. Hey, that's great because I think we're getting to the exciting part. So I just want to show you an example of a balance sheet, right? It's a statement of assets, liabilities, and capital, which owner's equity of a business. So take a look at this balance sheet, right? And I'm going to point a few things and how this balance sheet works. And it's, it makes accounting so beautiful, right? So you look at your assets, which you spoke about, right? You have cash, you have account receivables, you have inventory, you have land, you have building, equipment, and other assets, right? So remember that cash is a chart of accounts. So you need to set up all these chart of accounts for your books, right? Based on, and I already spoke, based on the nature of your company. Now you realize that total assets is 900,000. Now let's look at liabilities. Salaries payable and accounts payable, right? Your liabilities is 200,000, and your stockholders' equity, right? With it can be capital stock. Most small businesses don't have that. What mostly probably you're going to have, even not retained earnings, or you're going to have investment by owner. It can be as simple as that, right? You can realize that that is 700. So look at one thing. Your assets of 900,000 is equal to your liabilities, 200,000, plus your owner's equity of 700. There's a reason why it's called a balance sheet, because it needs to balance. I know it seems like, but I've had balance sheets that are not balanced, and I've had clients that have told, can you send me your balance sheet? And the total assets is not equal to the total liabilities and owner's equity. If that doesn't happen, you don't have a balance sheet, and your balance sheet is wrong. So make sure that any time that a bank is telling you to submit your balance sheet on a financial institution, or you have an accountant that is doing this for you, the first thing you need to look at is that your balance sheet balances. And I'm going to pause over there to see, John, are there any questions that people have?
John, while you do that,
there are.
John, while you do that, just a quick, I'm sorry, John, just a quick note, Nana, stockholders' equity, for those of us who may not know, is that the same thing as owner's equity?
Absolutely.
So it's attainable.
Yep.
Okay,
Yep.
fantastic. Thank you, John. You got the mic. You're on mute, John. We want to hear your nice voice too.
Sorry. This is the Zoom thing.
I think John, let me go through the revenue, the P&L section. I think people will have questions about that, and we can go and answer those questions, right?
Oh, okay. So
the next, I just want to talk about this, and we can.
Sure, no problem. Go ahead, Nana.
So now this is an income statement, right? So remember that we spoke about it, the same as revenue and expenses. So the differences that I want to make from the balance sheet to the income statement is that the balance sheet is cumulative. It's at a point in time, right? So let's say that you started your company in 2010. Your balance sheet is going to show all your transactions to date, depending on when your year end. Most companies year end on December 31st or whatever it is, but it's going to show all your income. It's going to show all your transactions to date. So if you run a balance sheet and say, okay, give me my balances as of September 30th, 2021, it's going to give you all balances from the inception of the company to September 30th, 2021. The income statement shows your information at a point in time, meaning that it takes it over a year or 6 months. It doesn't carry forward. So what your income statement is showing showing your revenues, right? Which is like, services, interest, income, or whatever revenues that you have, and expenses. So basically, on the nutshell, not to overcomplicate it, is revenue minus expenses, which is going to show your net income. And it's for a period in time, meaning that if I'm looking at the asset for the year ending December 31st, 20X9, it's from January 1st to December 31st. You can also have a P&L, profit and loss statement, that is also 6 months, right? I just want to make that clear. So John, now we can go to the questions and see if anybody has any questions.
Okay. So hold on one second. The first question came from Benjamin Joseph. Ben, do you want to unmute yourself and ask Nana?
Yeah, no problem. How you doing? Once again, my name is Benjamin Joseph. I just wanted to know the broad differences between the balance sheet and the chart of accounts, and the level of importance between the two, because I know most people they speak about balance sheets, but I don't hear much of chart of accounts. So can you guys tell me the level of importance, which one is more, or are they the same, like the differences between the two?
Yeah, and a good question. So when we're talking about the financial statements, right, there are three financial statements, right? Main financial statements. It's a balance sheet, your income statement, and your cash flows. Now, the chart of accounts is a line item on the balance sheet, right? So basically, when you go back to the balance sheet, John, you want to go back to the balance sheet?
Hold on one second.
So when you go to the balance sheet, for instance, you need your chart of accounts to create your balance sheet, right? So when you first set up your balance sheet, you need to understand what are the chart of accounts that I need. So for instance, over here on the asset side, right, cash is a chart of account. Accounts receivable is a chart of account. Inventory is a chart of account. Land is a chart of account. So the chart of accounts, all it is called what we call the financial statement line item, right? And basically what it is that you're categorizing all your cash balances to one cash account, a cash flow to one cash account. And the chart of accounts applies also to your income statement and your cash flow. So that's basically what it is, right? So I just want to make sure that you understand that the chart of account is not part of a balance sheet, but it helps you create your balance sheet. Make sense?
Perfect. Thank you.
All right. The next question, Nana, is what does cash include? Is it the same as a bank balance?
Sorry, John, I think, it was a little bit. What about the bank balance?
It says, what does the cash include? Is it the same as bank balance?
Yes. So basically, cash is basically what is sitting in your bank balance. That's accurately what it is. Yep.
Okay. The next question is from Peggy Hill. In which category would grants received from the SBA and et cetera be categorized? That's interesting because that's your specialty, isn't it?
Yeah, that's a great question. So a lot of accountants, and I'm not going to say, people usually tell you to put it in income, right? But let me explain something to you. When you're getting cash from the EIDL, right? So the EIDL is called the Economic Injury Disaster Loan. Remember that it's a loan that you're going to pay back. So where are you going to put it? It's going to be under liabilities. It's called a loan payable, and it's going to show in cash, right? So you have cash coming in, but you have to pay that money back. So it's a loan payable. Guess which part of your balance? Guess which part it doesn't affect? It doesn't affect your profit and loss, right? Because that's a loan. Now, if it's PPP, right? People have decided that they're going to put your PPP in income. But remember one thing, that if you go to your profit and loss statement, your net income is what you tax on. So basically, when an accountant tells you that, oh, you have an LLC, give me your Schedule C. Your Schedule C is basically your profit and loss statement. Your net income is going to be what you call your taxable income. You want to make sure that when you have a PPP and it is part of income, you're taking it out part of income, because you're taking it out of income because it's not taxable, right? So for me, my clients, I tell them that put that in equity and put that in cash. Don't even let that come into income. However, people that do their tax to me once a year, what I tell them is that tell me within the income that you have, which one is an SBA PPP, because we need to exclude that from it so you don't get taxed on that amount. So that is very, very important question that I think everybody should know on this call.
All right. We have another question from Melinda McCarthy, and Paul Rosenblum tried to answer it, but I think he's pretty good on his answer, but I think you might be able to clarify a little bit more. What if the balance sheet does not balance?
Then you don't have then there's something wrong. You don't have a balance sheet. The reason why the balance sheet has to balance is just because that's how you catch an error, right? From the balance sheet not balancing. And then again, we're going to go, the next slide is going to talk about debits and credits, right? So if your balance sheet doesn't balance, what it means that you have a debit, but you don't have a corresponding credit, right? So that you need to go back and figure out, for instance, when you have cash coming in, right? And you use that to pay, let's talk about the year, you use that to pay a loan, right? You want to make sure that you put in the cash, right? And you decrease your liability. So anytime that there's a debit, there has to be a corresponding credit for it to balance. If your balance sheet doesn't balance, there is a mistake on the balance sheet.
She has a follow-up question to that. She's like, if you're working at a loss, should your balance sheet still balance?
Yes, it has. So
Does that mean that your loss is on both sides?
No. So let me explain that. That's a great question. Let me explain how the P&L and the balance sheet works, right? And maybe, John, maybe you want to go on the next couple of slides. I want to explain something. I think that's going to help people. Next one. I'll talk about the cash flow for a second. Let's go to the next one. Okay, beautiful. So I think I want to focus on books and records because that's where people seem to be pretty much interested in what's going on. So books and records refer to your business accounting, right? So the book shows revenue and expenses. They are usually recorded by using a debit and a credit, right? And this is one of my favorite topics. It's something that we call the T account. This book shows assets, liability of a business, right? And so what is a debit and a credit?
Donna, hold on a second. I'm going to tell you right now, because when I first dove into bookkeeping, this was such a problem for me because the language to me, like the way I know debit and credit is only one side of the accounting because that's the side that I deal with. Like when I use my debit card and I get credit, those are two different things when we're talking about accounting. So people really need to get adjusted to what debit and credit means when it comes to accounting, because it all depends on what book you're talking about.
Exactly. So you're absolutely right, John. And this is what is really creating the confusion. And that's what I want to spend some time over here.
Let's do it.
Because and I used to teach this course, right? So this is one of my favorite topics. So let's take, for instance, we talk about assets on the balance sheet, right? So if you want to increase an asset, what do you do? So when you have a bank account and the bank account is showing credit, right? You say, oh, credit, that means I have money. But remember that what the bank is doing is the bank is showing it from their point of view, not your point of view. So that knowledge that you have on the bank account, let's put that on the side. Let's look at your books, right? Don't follow the bank's book. So when you want to increase an asset, you debit it, right? You see the plus sign, assets, debit, plus, it goes up. So what cash is coming in, what do? You debit it. So you have a cash of $500 coming in, you debit your cash, right? Now, the question, if people that have QuickBooks, right? So let me give you an example of QuickBooks, right? If you connect the QuickBooks to your bank account, all you're going to see is one side of the transaction. If there's an increase, the QuickBooks is going to show money coming in. If there's a decrease, it's going to show the money coming out. So what the QuickBooks is doing is just showing one side of the transaction, decrease in cash and increase in cash. Now, the next question is that if there is an increase in cash, right? What is the corresponding credit? So let's say if it's due to revenue, you have a business and money has come in. What has increased? Cash has increased. What else has increased? Look at the other side. Income, right? So you credit your income. When you credit your income, you increase your income. So again, that's what you've done. You increase your assets and you increase your income. Your debits 200, your credits 200. Boom.
Okay,
It
Nana,
balances.
I have a quick question. All right.
Okay.
I got a business and I need
Yep.
to buy a truck, right?
Yes. Yep.
Now, I got a great deal. Someone offered me a truck for $5,000.
Yep.
I got 20,000 in cash. Now,
Yep.
that means if I buy the truck, then my assets increase, right?
Yes.
But then
But what else?
my cash has to decrease though, right?
Exactly. So
that's how it
good
stays
point.
balanced, right?
Exactly.
So I have to book it in two places. I have to book it in my assets going up $5,000 and my cash decreasing $5,000, right?
John, I think you can teach this. You're
Well, no.
spot on.
I just
no. I think and this is why I like about accounting, and I'm glad you're having this conversation, because anytime that I have a class and I explain this to people, it just clicks, right? And it's spot on, because I think it's a beautiful example that you made, right? Because what it is that your assets have increased, so now your cash balance is going to go from 20,000 to what, 15,000, right? But guess what also increased? Your assets. Because
right.
what is an asset? Your truck.
Right.
Exactly.
My truck is an asset. Right.
Exactly.
And then after time that depreciates, and I gotta decrease my assets and increase my depreciation book, right?
And what is depreciation? It's an expense.
Right. So that's
Exactly.
how my balance sheet has to stay balanced, because wherever the money's going in, it has to come out from somewhere, right?
Exactly. And let's take one example about a decrease in cash, right? So if there's a decrease, I think you give an example. I want to give an example. So let's say you use your cash to go buy materials, right? Or let's just spend on a company expense. Guess what is decreasing? Your assets, because cash is going down, right? And so if the cash is going down, what do you do with the cash? You credit the cash.
Yep. So
you need a corresponding what?
You need a corresponding debit in another book.
Exactly. And what can you debit that is going to be equivalent? Either it's going to be what? A liability. So let's say if it's a liability, let's say you have a rent payable of $600, right? And you pay that, it's going to decrease.
Right.
What about if it's an expense? Right? So remember that the expense, if you decide that you're going to debit an expense, right? You also decrease your expense. Right. So that is the way that the balance sheet, I just want to focus on the balance sheet and the profit and loss works together. Right. It really works together. Right. Debits, credits, asset, expenses, you credit expenses, you decrease in it. Liabilities and income. So that's how much it interrelates with each other. Right. And I just want to pause here for a second, because once you get this, everything in accounting will make sense to you. And even if you decide that you're going to keep your own books and records, you have an accounting software. Let's say you're a business owner, right? You're sitting down saying that, okay, I have cash coming in. Is that revenue? So let's give an example. What about if a business owner says that I need to infuse money into my company? Right? And is that a trick question? What about if I want to put money into your company? What is increasing?
Well, the cash is going up, right?
The cash is going up. What else is also going to increase?
The assets?
No. You close to it.
The equity?
The equity. Yeah.
You're right. Yes. Yes. Beautiful. I love this part of it. I think it just brings everything together. Mr. Benjamin, that's great. You know, it feels like you're an accounting class 101, right? so that is how it works, right? You know, once you get a grasp of what we call the T account, understands how these moving parts work, you have it, right? Let's say, John, you give an example that you said that, I'm the owner, right? Cash is going up. You said expense, right? But for expense to go up, right, you need to, you see, it wouldn't balance because all of a sudden you say, I need a credit. No, my expense is not going up, it's going down. So you realize that, oh no, that doesn't have to increase. So that's the way that when somebody spoke about what if your balance sheet doesn't balance, that's how you're going to catch it, because
that's how you catch errors, right? If it
errors.
doesn't balance, you have to find out where you made a mistake. You booked it wrong somewhere, right? Just to recap, you already answered this question, but somebody asked, would a grant be considered income? Ms. Jones, Nana already said that if it's not taxable, it should not be in your income.
Yep. But if it's taxable, it should be. Yep.
It depends on whether or not it's taxable. All right. So I want to continue, right?
Yeah. And I just want to make sure that, because, this is very important. If anybody has any questions, they should ask now, because this is very important. I think this is the nuts and bolts of accounting books and records, right? The others, we're going to kind of skip through it. So I just want to make sure that before we move on, if anybody has any questions that we can use as an example.
Ali Akbari, you want to unmute yourself and ask your question?
Yeah, I'm just asking about shareholder loan. How do you deal with shareholder loan here? Is it liability go to the balance sheet? Then is it credit, or is debit? When is credit, when is debit here? That's something usually shareholder take money out or shareholder put money in. How do you deal with this one?
That's a great question. So on the honest equity side section of the balance sheet, there's something that we're going to call owner's contribution and owner's withdrawal, right? So let's look at this, for example. Anytime that there's an owner's contribution, you put the money in, you increasing, what are you increasing? Your cash. And what are you increasing? Your equity, because you're putting money in. Anytime that there's an owner's withdrawal, right? What are you decreasing? Your cash. And what are you decreasing? Your owner's equity, right? So if you follow the T account, you're going to realize that that's how you're going to deal with it. But there's one also example that I think that I want to make. What about if there are multiple owners and one of them decides to loan the company money? They're not contributing into the company, but they are loaning the company money, right? It's still going to be a loan payable, because that is the money that you have to pay back. Anytime that you have to pay something back to somebody, right, whether it be a shareholder, right, you're going to say loan payable. You're going to increase cash, but it's going to be loan payable. But if you are just contributing money to boost up your business, right, it's owner's contribution, right? So I just want to make sure that we have that concept, in our mind.
Nana, we have 2 more questions and then we want to move on. All right.
Okay.
So,
yes.
Digna Ramache asked, how would you book rental cars for business, right?
So rental car for business. I just want to follow this T-sheet. So when you're renting a car, what are you using to rent a car? Is it cash? So your cash is going down, right? It's the same as an expense, right? And it's also an expense. So decrease in cash, right? And expense, right? So cash is going down, you credit cash. What else are you going to debit to increase in expense? So that's how you book it. So remember that rental car business is just like a business expense. You always decrease in cash. And there's a decrease in cash. You're going to say, okay, this is an expense, there's the other side, right? Credit cash, debit expense.
All right. I kind of had a little white lie. Sabrina Scott asked, can you elaborate on capital stock and owner's equity? How are those values derived?
So let's say capital stock. So capital stock is a very complicated concept, right? So capital stock is basically how much your company is worth, right? I wouldn't want to confuse, because most people on this call, it may not be beneficial, but a capital stock is, say, remember that you have people that have an S corp, right? They say, your company is valued at $1 per par, right? And over the years, you're going to realize that, okay, now I've valued my company, which was like, $1 per par, I have 100 shares. So it's $100. But now my company is valued at $2 per par. So now it's increased. So that you're going to have an increase in owner's equity because your company's value went higher, right? The reason why that's conceptually, I don't want to focus too much on that. It's just because of the fact that if you're a small business owner, most likely your company, usually these are really important to companies that are going public, or if you want to sell your company, right? So a public company, the way that you want to see the stock market, right? Basically, you buy the stock of the company. And based on how much the company is worth, you're going to realize that you bought the company stocks. Like people that bought, let's say, Apple 20 years ago, the stock was maybe $5 per stock. All of a sudden, the Apple stock is $200. So if you have $150 per stock, you have $20,000 stock, you're a rich person. So that is how much that is derived. But in terms of a single owner or a business that's not public, usually that is really your value of the company. And remember that the more money that you put into your company, the more that you increase the value of the company, right? If you infuse capital in your company, you increase the value of that company.
All right. And then the last one before we move on, I know there's more questions, but we got to move on. What about bartering? Where does that fall?
So bartering, what I extend would say bartering is that exchanging one item for the other, right? So you have to understand that in the early days, when there was a barter exchange, right? You always need to know what the value of that item was. So maybe John has a car, right? And the car is on his balance sheet. His value, the car is an asset, right? Like you said, the car is valuable now. It's an asset. It's a business asset for $10,000. And you get to a point where it's an asset, right? And remember we spoke about an asset. An asset is an item that is easily convertible to cash. At any point in time, John can decide to sell the car to get cash. But instead of him going through the whole process, he can go to Damaris and say, hey, Damaris, I need some raw materials for business. I'm going to give you my car, which is worth $10,000, and give me $10,000 worth of inventory, right? So all of a sudden, you're trading your car in, but you always know that there's an assigned value to it, and you're replacing that with inventory. So, car is going to go off the box, right? You're going to, it's 10,000 off the box, an inventory of 10,000 of car, whatever value that you decide to sell to the mirrors for, and it has to be an equivalent. That's why it has to be a like kind exchange, similar. You cannot do a barter system to both companies, or you can say that, hey, my car is valued at 5,000, but I'm going to add an additional 5,000 cash so that I can get 10,000. So that is how you move. But remember that anytime that you're exchanging something, the IRS, I'm going to tell you right off the back, it really frowns upon bartering because it wants to make sure that people are not finding that way to hide their cash. Because the only time that the IRS gets paid is if there's income. So if they see that money is moving around with no income, they're questioning. That's why when you have a corporation, the IRS just doesn't ask you for your profit and loss. They also ask for your balance sheet, right? Because they want to understand what is going on in your balance sheet. And if they see that going on, they're going to have a question for you.
They want to see where the money is moving from one
Exactly.
to the other.
Exactly.
So they can question the transaction within your books.
Exactly. And lifetime exchange is one of the things that they really look at. Bartering is one of the things that they really look at.
All right. Cool. So we're going to go back. I think we did income statement or cash flows?
Cash flows. Yeah. So cash flow statement, cash is king. So this is this is also key. So why is cash king? So your ability to sustain yourself as a company is able to have cash inflows and cash outflows. So now the banks, if you're going to go for a loan or a grant from the bank, they are starting to ask small businesses to also provide their cash flow statement. And which is interesting because you know what? You know, a lot of companies, although they are showing a lot of money, account receivable, which are assets on their balance sheet, they're not getting paid for it. So they don't really want to understand, okay, what is money really coming in and coming out? So a cash flow statement is really inflows and outflows of cash, pure cash. So let's say to operating activities, right? Cash received from customers, 720. Cash received from interest, right? Let's look at one thing that I really want to talk about is going to be cash, account receivable, right? Anytime that there's a change in account receivable, right? If account receivable decreases, it's always a good thing. What does that mean? It means that you're getting cash. So if your account receivable on your balance sheet was 200,000, but yet your next, statement is 150, what it's telling us is that $50,000 of cash came in, right? So that's how you're tracking cash, right? And investing activity. What are you using your cash to buy? What are you using your cash to, because anytime that there's money coming in, it's positive. Anytime there's money going out, it's negative. So it's a cash paid for other items, for the like, it's a negative 300,000. The thing about the cash flow, which is also like people hated accounting because if things don't balance, you need to find out what is not balancing. Look at cash as of December 31st. What is that balance? Right? That balance is basically $192,000. John, let's go to the balance sheet for a second. You see, $192,000, right? So your cash flow, the ending balance as of December 31st, should tie into your cash balance that is over here, right?
Quick question.
Yeah.
What if your cash flow is negative?
That means your cash account. That means you have a negative bank balance.
Does it mean I'm out of business?
That means that you're insolvent. So interesting. That's an interesting question. So I had a client who said, the bank, they're looking for a grant, right? And a quick example, it just happened. So the bank wants my balance sheet, and the similar thing, the balance sheet went negative 1 month, and the question is that the bank said I should show a positive balance sheet, right? What is the best way of doing that? My quick answer is infuse money. Put in your own money, right? When you put your own money, it's not going to affect income, but your cash balance is going to be positive and your earnest equity is going to go up. Right? That's the quickest way. Now, let's go to the cash flow statement. So as you see this, so basically what it's saying is that the cash balance at the beginning of the year, January 1st, was 397,000, right? Your cash balance at the end was 192. So guess what? You spent $205,000 during the year, and that is the breakdown. This is important because it shows you exactly what you spend your money on. If you're able to get a grasp of this cash flow statement with your other balance sheet, income statement, understand how all that comes together, although you may not have a positive, like John would say, a positive balance, you know exactly where you stand. Right. So that is, I know somebody had a quick question, but John, I don't know where you want to take a question that we can move on to the next slide.
I think this question is directly correlated to this slide, so I think it's important to talk about it. It says, if you put your own money, will it affect your taxes? So if you do a capital infusion of your own money and increase your equity, will that affect your taxes?
That's a beautiful statement. And let me show you how the accounting world works. I always want to go back. So when I began my the webinar, one of the things that I said about taxes is that you get tax based on your net income, right? So, your assets, when you go to income statement for a second, John. So for this particular client, right, the IRS is going to tax you. Is going to 115,000 is your taxable income. And John, I know you went through this the PPP line. That's line 31, right, of your Schedule C. So basically, that's where this amount is going to be. That is where you go to. That's what you're going to get taxed on. When you put your own money, guess which part of your statement that it doesn't affect? It doesn't affect your income statement because remember, your cash increases and the equity increases. It doesn't touch your income statement.
Because it's not revenue generated from business.
Exactly. You got it.
All right, last question for this, and then we'll move on. Cash flow statement is calculated monthly, right?
You can calculate it monthly, quarterly, yearly. It depends on how often that you want to be able to calculate that. But my advice is that you should do that together with your P&L and your balance sheet, which is monthly. So if you do your balance, your P&L on a monthly basis, my advice, which I encourage everybody, do your cash flow statement. And the good thing about cash flow statement is that if you do have an accounting software, which I think we're going to go into it a bit when we have time, it does it automatically for you based on the movement of cash. It calculates the cash flow statement automatically for you. So,
that's a
the only
beautiful
time
thing.
that the only time that your cash flow statement is going to be off if your balance sheet is off. If your income statement is like, if your balance sheet is off, your cash flow statement is not going to tie, right? So it all fits in together. That's why they ask for all these three things, right? Because they want to make sure that it makes sense. So usually, if companies get so frustrated, they plug in a number in the balance sheet for the cash flow to tie, but the bank is going to realize that what is this number? Why are you putting everything in other expenses? What is in other revenue? What is in other income? What is in other assets, right? They can ask that question if they realize that the number doesn't make sense, because people have a difficulty tying the cash flow balance. They're like, let's plug in the number, let's make it work. But that's not a good practice.
What I've noticed, Nana, is that people who do their cash flow statements monthly are able to project what their cash flow is going to be like next month, and then based on that, be able to make decisions on whether they want to increase assets, whether they want to invest in other things, whether they want to expand their business or contract their business to make sure that they are positive in cash flow the next month. So it's really important to do it as often as possible.
Yep. And you're absolutely spot on, John. Yep. You're right.
All right, next one.
Next slide. So I think we already spoke about this.
We did. But I mean, you want to review or you want to go next? It's up to you.
I think it's good. I think we beat this topic down. I want to talk about the other, unless somebody has a question at the end of but I think we could go on to the next slide.
All right, moving on.
So, and I think John mentioned all the good points, right? Books, why books and records important, helps businesses stay on target, monitor their financial health. Second of all, you are required by law as a small business in order to keep them, right? So if you have an LLC, they ask for the Schedule C or your sole prop or even independent contractor. Your Schedule C is basically your profit and loss statement. If you have an S Corp, a partnership, a C Corp, basically they're going to ask you for your balance sheet, right? They're going to ask you for your P&L, right? And also they're going to, within that, they're going to ask for your owner's equity statement as well, right? So it's required by law, right? In the event of an audit or lawsuit, right, you want to make sure that, even, let's not even get that far. If you go to the bank requires everybody. If you're even going to get a $5,000 loan to have your financial statements, that's the first thing they're going to ask for. They're going to say, this should be looked by a CPA. And I can tell you one thing for sure, that if somebody's on my client and they kind of say, hey, Nana, they say they need a CPA to look at this, I'm going to be like, listen, you know what? I need to go back and check all your receipts to make sure that whatever that you're putting there is accurate. Because if I'm going to put my name on direct, I got to feel comfortable about it. People that are my clients, I know that on a quarter basis, I'm monitoring the financial, the bank statement and all that stuff. So I know what is coming in and going out. Right. Next slide.
Real quick, Sabrina's asking me, but I'm going to turn it back to you, Nana, since you're the expert. Cash flow statement, P&L should be generated monthly. What about balance sheet? I think they monthly. All go together, right?
They all go together. So those are three. When we beginning in this webinar, we're talking about three important financial statements: balance sheet, income statement, and cash flow. It all goes together.
So what I've been learning in small business lending is that the most important reason for having all three be as accurate as possible is because it will tell lenders how much you can borrow without becoming insolvent.
Yes.
And as lenders, if we're honest lenders and we're really trying to help your business, the last thing we want to do is lend you money that you're not going to be able to pay back. And it's really important to be accurate with your income, because from a lending perspective, if you show me that you're making this much money, then I can lend you that much more. A lot of people sometimes are like, well, but then I have to pay taxes on all this money. But if I can expense all of this, maybe it'll help me. Well, the question is, do you want to use other people's money to grow your business, or do you want to continue just using your money to grow your business? Personally, if I were a business owner, I would love to keep my money in my bank account and use the bank's money to make me more money, and I'll pay them a little cut, you know? So that's just my perspective on that. Correct me if I'm wrong, Nana, but that's just how I ride.
Yes, spot on. And that's what creates insolvency, right? And that's the one thing that people, I see a lot of small business owners saying that I put in so much money and, I don't have any more money. My business is failing because you know what? The best thing is that, like John put it right away, that you want to be able to make sure that you are using your status as a small business owner to generate capital for your company, right? Meaning that, you go to organizations like BOC saying that this is my financial statement. Maybe this month, John is going to tell you that based on your balance sheet and your income statement, I'm only going to be able to give you $2,000. Well, you take it. The next time you're going to come, okay, well, we're going to be able to give you $6,000 based on this. You take it. That's how you grow your business, right? You grow your business because you want to take it in steps. You want to get a lot of money, pay that back, increase your productivity. Because guess what? That $2,000 that John may give to you, it may generate an income of $10,000. So all of a sudden, you're coming in showing $8,000 revenue. You paid off that loan of $2,000 already. John is going to look at it and is going to say, oh, this is great, right? I'm going to give you $8,000 because that's how much you're generating. That's how you grow your business as a small business owner.
So one more thing I want to add to that, maybe just to like simplify it a little bit. For me as a business owner, if my income is 100,000 and I report that 100,000, yeah, I got to pay the government maybe 21, 22, 24% of that. But guess what? I get to give them 25,000, have 75,000 in my bank account. Now I can go to the bank and say, hey, I want a loan based on the 75,000 that I have in my bank account. Will you lend me 40,000? And they'll probably say yes. But if I say, if I generated 100,000 in revenue, but I expensed 80,000 of it and I'm only showing 20, then guess what? The bank's going to say to me when I want 40. They're going to say no, because I'm only showing, I'm only making this. So that's the reason I look at it that way. I'm hoping that my analogy is easy to understand.
Yeah, makes sense. Perfect. Next slide, unless you want to take some questions, but let's go to the next slide, John.
So Fatima asked, should we apply for SBA loans like the EIDL?
Absolutely. So one of the things that I always talk about, people that have come in to me about the EIDL, is that I don't think that in my lifetime or in our lifetime, you're going to get any institution that is going to give you a loan to pay over 30 years at 3.75% with no collateral, first 2 years, no interest rate, or no payment, moratorium for the first 2 years.
Unbelievable.
It's not going to happen. So even if you don't need the money, like John said, you take it and use it to increase your business. The worst thing is you can always pay it back. But this wouldn't happen in a lifetime. And now, if you're going for a traditional loan, there's a whole lot more requirement that you have to meet than it used to be for the pandemic.
All right, we're gonna move on.
So I think we mentioned this. I'm going to go through it briefly, how to maintain accurate books and records. And somebody said we have to do consistently, right? If there's a budget constraint that prevents a small business from hiring a bookkeeper and accountant, at the minimum, all income and expenses should be logged and then sent to a bookkeeper or accountant to review, monthly or quarterly, right? But you want to make sure that you're doing the right thing, because if you walk to a place, they're going to say, hey, your balance sheet, the worst thing that you want to work into, go to get a loan, is to send your balance sheet and it doesn't balance. Right. Next slide. So common issues business owners have with choosing the right accounting software, and I just want to quickly mention this. So you just want to make sure that this accounting software fits your need. And I use QuickBooks quite a bit, so I put some of the things on QuickBooks, based on the different level, and I rank it from the most expensive to the least expensive, right? So there's one called advanced. It's for clients with growing teams who need advanced automation and reporting customization. Most people don't need that unless you have about 15 employees. There's a lot of customization going on, but I wouldn't say you're going to need that. But then again, like they said, during the free 30-minute consultation, I'm going to be able to tell you exactly, if you did that or not. But most businesses that I've seen, nobody has needed advanced. The class, for clients who also need to track class and location inventory profitability, about 20% of people need it, right? The one that people really need is essential, which is, that's just the basic. You have 3 users, you can track time, you can connect your bank account. The most important thing is being able to connect your bank or your credit card statement to your to that software, right? So, essentials and simple start is where most small businesses fall. However, if you get into the area where you need a bit more sophistication, at that point in time, my advice is that you may as well just outsource that, right? When you get to a plus and advanced, I don't even advise that you start doing that on your own, because then it becomes sophisticated. Right. I don't know if anybody has any question. I think let's move to the next slide, John. Let's see, and we can maybe take questions at the end. So what are the 5 common financial mistakes that small business owners make that will cause their business to fail? Right. Next slide. Actually, you know what? I made it 6 because there's one thing that came up that I feel like was very important, and that's the second point. But the first point is mistaking revenue for profit, and we spoke about that. So what is a profit? A profit is your revenue minus your expenses. And I added the second point because of the whole PPP thing that came, that what is the difference between the gross profit and the net profit? I think that's important, and I just want to take a moment to touch on that point. So a gross profit is usually applicable to businesses that have cost of goods sold, right? Meaning that you generated a specific product, right? Usually goes to the people that have goods. Maybe somebody sells lotion, right? So a lotion is you need to buy the materials, the container, the raw materials, the labor. So you're going to put all that together to create one bottle of lotion, which is going to be about maybe $5, right? You sold the lotion for $10. So 10 minus the 5, this is how much that how much that went into produce the lotion. It's a $5. The $5 is your gross profit. So when you look at the PPP, they said Schedule C, line number 7. That's what we're talking about, gross profit, right? Because it is revenue minus your cost of goods sold. Now, from gross profit to net profit, you need what we call the expenses. So let's take to one particular example you're using. That you have $5 of gross profit. Well, then you have advertising costs, rent, like someone said, rental, or Uber to take it, transportation, rent. Like you calculate all that stuff, and you realize that it costs you like $3 to actually, get with all these other expenses, overhead expenses, I call it, right? Now your net profit is $2. So and I think we mentioned that several times, guess how you get taxed? You get taxed based on your net profit. on Schedule C, line 31, right? That's how much. And if you even have an S corp, it's going to be your net profit on your income statement. That is going to flow to your K1. That flows directly to your individual tax return. That is how much. That's how you get taxed, right? Now, one other thing you need to avoid is high overhead costs. If you're starting a business right off the back, see if you can do that in your garage. Like the biggest businesses, you know, the Apples of the world, the Microsofts of the world, started from the garage, right? Do not try to get high overhead costs when you're not ready. Your business is not generating that much revenue to be able to pay that yet. That's how it's going to make a business. And running your business on credit, that's what we mentioned on the cash flow is king. You have a big asset, a big account receivable. Guess what you don't have? You don't have cash flows if people are not paying you. That's why now the banks want to see your balance sheet and your P&L because they want to understand how much of your account receivable are you turning over? How much are your creditors paying you back? Right? And that is why you want to make sure that for the most part, you need liquidity because liquidity is what is going to keep your business afloat. Right? And failure to keep track of inventory. This is very important. Like I have people that have sandwich shops, right? Well, guess what you buy? When you buy bread, you know, you buy the, you know, whatever whatever that you need to make a sandwich. It's all inventory because it goes into producing that product, right? And that is part of what you call your cost of goods sold. You want to make sure that you're keeping track of that and do not record your inventory just as expenses, right? Make sure that if you're buying something, you're in the business of manufacturing something, you buy something for your business, you're recording inventory and you're recording expenses. Because inventory is what? It's an asset. We already looked at that. And do not commingle your business and your personal expenses. That's a no-no. If you're an independent contractor, just go to the, you don't want to register a company, just go to the council clerk's office and just register as sole proprietor and open a business bank account. Right. That way.
Nana, even sole proprietors have trouble separating their business.
Exactly. You don't want to do that because guess why you don't want to do that? If you're linking your books, if you have a software, it's going to link your bank account to your books and records. It's going to pull in every transaction that you have. If you have a personal bank account linked to it, guess what? It's going to pull in over 1,000 transactions, and at that point in time, you don't have a business anymore because your balance sheet and your P&L is not going to be an accurate reflection of your business. Period. So open a business bank account. Extremely important. Next slide, please. Is it too late to start? If you've not been keeping your books and records, it's too late to start it. It's not. I've had somebody who came to me. They have not done it for 2 years. We're able to get together and do it. But the most important thing I'm going to tell you is that if you've not done it, what you can do, fill up. Hopefully, you're keeping your receipts. Go to your bank statement. Start logging into Excel. What are my expenses? It's important to keep track of your expenses just because you just want to know what you're spending your money on, and also for taxable time, because the only way that you're going to know how much money you're going to get taxed on is if you have receipts for those expenses.
So Nana, I have a quick question about that, right?
Yeah.
So I personally don't use cash anymore. I only use my credit card.
Yeah.
If I don't have receipts, can I use my credit card statement?
Absolutely.
As
Absolutely, you can.
A basis for my accounting.
Exactly. You can. And that's a good question, because what happens is that, the reason why it's also important is just because you get audited, right? They're going to ask you that, show me that you bought this for that. You can go to your credit card statement and do that. And the good thing about the credit card statement now is that when you print out your monthly statement, it categorizes that for you based on what they think the transaction is. It's going to say, hey, John, this month you spend, $1,000 on meals and entertainment, right? Because maybe you use your credit card to, go to your grocery shop, whatever it is, or you spend $50 on tolls. You spend this on that. So the credit card also helps you keep track of that. But you're absolutely right that you can also use that as a basis for you to actually generate your P&L.
There's a question in the chat. It says, how long do you have to keep receipts for the IRS, New York State, and New York City taxing agencies?
So So the standard rule is 7 years. However, and this is important, if there is belief that there is something fraudulent, you need to keep it for a lifetime. They can go back as many years as they want. Right. So my answer to you is scan it in, save it, and keep it as long as you can. Now scan it in, save it, and keep it as long as you can.
Nana, quick question. Are you done with this slide? Should we go to the next slide?
Yeah, next slide. Yeah.
All right. So
I think this is the end of the presentation.
this is the end of the presentation. I am going to put the link to the survey in the chat, but I do want to get to the great question that Fatima just asked. She said, I have a business bank account. However, my credit cards are not in my business name, but in my personal name. Is that commingling? I want to know the answer to that question, Nana. I have that same problem.
So now the question that I have for the person is your credit card a business credit card or personal credit card?
I think she means their personal. Fatima, you want to unmute yourself and ask the question?
Yeah.
Fatima Murray, if you're there and you hear me. Let's assume that they're not a business credit card. It's a personal credit card.
Yeah, so.
I'm sorry, yes, I moved myself. Yes, so it's not a business credit card. So it's a personal credit card, but I use it for my business expenses to keep track of everything.
Yeah, it is commingling because the reason why I
have other credit cards for my personal use. I just got a new credit card and I'm putting all my business expenses on it. But it doesn't.
That's fine. That is fine. So that is dedicated strictly to your business.
Correct.
That's fine. Commingling happens if you're using it for both business and personal at the same time. But if it's just dedicated to your business, that's fine, because the only thing is that you can go to that particular thing and just say, and that's a good thing about credit cards, right? You can just go to that particular credit card and just look at your expenses, because the only thing that the credit card is keeping track of is it's just keeping track of your expenses, right? So you can even link that to whatever software it is, but you can say, okay, these are my business expenses, and I can categorize that. So that's fine. But do not use that for personal.
Nana, wouldn't it make sense to establish business credit versus personal credit and have a business credit card? And if so, just a shameless plug, BOC has a grant opportunity with HSBC. If you do not have a business secure, credit card, we can provide you with a $500 grant through going through our business credit program training, and then you would put in $500 for that. If you're interested,
Damaris,
email me or John.
You stole the words right out of my mouth. It's an amazing program. You put $500 in, HSBC then gives you $500, and then you have a credit card that's for your business. That's $1,000 for you to be able to use for your business.
Can I give you another reason why I like business credit card? Business credit card do not show up on your personal credit.
Woo! I love it. All right. I've been holding these people hostage for a really long time now, Nana. I am going to put the link to the survey in the chat. All right. So if you want a one-on-one 30-minute consultation with a CPA for your specific needs, it might be Nana, it might be somebody else. It all depends on what your needs are. And I need you to clearly define those when you answer the survey. I really appreciate everyone here. We can continue doing more questions. We are over time, but the fact that you guys are still here and are asking great questions means that we should keep going. I will go for another 10 minutes, giving you guys a chance to fill out the survey. Make sure you fill it out if you want that one-on-one. Okay, so the next question from Natasha. Natasha, you want to unmute yourself and ask?
Sure. I'm a new business owner and I've been trying to establish business credit. And when I go to apply for business credit, I notice that my personal credit is being dinged. How long will that happen before I can just go off my business credit?
Nana?
So yeah, I can take that. In order to establish business credit as a business owner, your personal credit also needs to be perfect. That's the initial stage, right? So you actually are successful in getting a business credit, right, through your personal credit the initial time. Unfortunately, that's the process. That's why Demira's point that she made was a great point with the HSBC. Those are, you need to look for programs like that are really specific to startup small business owners, right? And you don't have to start from a big amount. You can start from $1,000, but you want to be able to establish business like the same way that your credit profile has you build credibility. The business also has to build the same thing as well, right? Because when you're going and you're listing for a loan, they're going to ask you, what business credit cards you have and what are the balances on it. Right? So unfortunately, in order to establish that, your personal credit status get hit, but the program that Damaris and John are talking about is a great example for something that a small business owner startup should use.
Okay, some people are saying that they're having issues with the link. I put it in the chat again. Please try again and let me know. Melinda, can you try one more time? The last link worked. Thank you. All right. Melinda, once again, try one more time. That was on me. I actually had the settings set where you had to be a specific group of people to get it. I apologize. Thank you for letting me know. And I'm glad that we're still going. Yes, the link works. Sabrina, awesome. Awesome. Mr. Lore, can you unmute yourself and ask your question?
Hi, it's a lady.
Oh, I'm sorry, Kay. I assumed, my fault.
It's okay. So I wanted to understand when we're purchasing homes, I hear people say that when you're renting to tenants, that's also considered a business and that we should be very careful and mindful of that as well. So I am thinking of purchasing a multifamily property and I wanted to know, and then I hear people telling me it should be an LLC, it could be a sole proprietorship. But I'm thinking to myself, when do I start to prepare and get a bank account, get a credit card so that the expenses that are going into the purchase of this home are tracked appropriately?
So wait, Nana, can I ask her some questions before you start?
Yeah.
All
Go
right.
ahead.
So full disclosure, I'm a Dominican immigrant. My father started off with a bodega and just started buying property and is doing just that. Now, the way he has it set up is he has his LLC. He's an employee of the LLC. It pays him a salary, right? Because he is an employee of the LLC. And the question for me is, are you living in the property or go ahead.
I will be.
All right, so if you're living in the property, it changes a little bit, and that's where I'm going to ask Nana to step in because that's when it gets kind of crazy. If you're living in the property, you get to treat 75% of it as a business, and 25% of it would be your. Actually, no, it depends on if you have 4 units or 3 units. If you have 3 units and you live in one, then 30.
Go ahead.
Sorry. If you have 3 units and you live in one, then you can use 66% of it as your business. If you have 4 units and you live in one, then you can use 75% of it. It depends on what you're using for your personal self and what you're using as a business. But you could also pay yourself, and that could also be deducted from the business operating expenses because you're paying yourself as an employee. And Nana, you could step in from there.
No, I think you did great. But one important thing that I need to mention is I had a client who, same scenario that you have, and she owns multi-unit properties, but she decided to file it as a partnership, right? Because it was a combination between her husband and herself, right? Now, that's fine. Like, you don't need a partnership in order to be able to file as a partnership, because if there is a percentage split, you want to see that. But when you have taxes, right, there's a few ways that you can be able to do it. Either doing it as a 1065 or something called the Schedule E, which is rental, business and expenses. right? That is for non-registered people that, own it by themselves. One of the reasons why I like the aspect of the LLC, right, which I think, the IRS is trying to is trying on that these days, is just because of the fact that if you have losses, right, and you don't identify yourself as actively participating in the real estate, there is a loss limitation, meaning that you can't take all your losses to go against whatever revenue that you have. The loss limitation can be up to $3,000, meaning that if you have incur a loss of $100,000, you're going to be capped at $3,000, and the rest has got a passive income. The rest of that income is going to be carried over for years upon years. However, if you find yourself as actively participating in real estate, right, you're able to deduct in full all your losses, right? So those are some of the things that you need to look at. But to John's point, you need to determine, I think, that the best route to go is really, like John said, have an LLC, because the thing that it gives you is that you're also able to purchase multiple properties under the same LLC, right? I'm always a big fan of that. But then again, if you don't want to go through that, you can just own the property as a person, and you can just file out the Schedule E. You're still going to report as business rental income and expenses on the Schedule E. That's part of your 1040.
I wanna also add that the benefit of having an LLC when you own a property is that if by some chance someone gets hurt on your property, slips on ice, slips on anything, you're protected legally, where the only assets that they can go after are the building's assets, not your personal assets. All right.
Is that different than the sole? So is that a strict difference between a sole proprietorship and an LLC? If it is a sole proprietorship?
So as a sole proprietor, you are the owner of the business. As an LLC, the entity is the owner of the business, and they can only go after the entity's assets.
Now, I was told that, okay, now hopefully I'm not taking people too off course. One thing, Nana, I heard that you shouldn't put too many properties in the LLC because you want to protect each property. That's one thing. And the second thing I was told is when you do an LLC, when you're purchasing insurance, you're still going to have to, the bank, and this is perfect because you guys, will be able to tell me this, that the bank is still going to require the homeowner to have insurance as well as the LLC, because the bank is going to want you to put them as a beneficiary on the insurance policy. Please correct me if I'm wrong.
So you're absolutely right. If you're talking to me 2 years ago, I'd have told you that you're spot on. But as of this year, I can tell you right off the bat, because I pull a lot of the IRS guidance, the IRS is frowned upon multiple LLCs under the same rate, because everybody in New York City right now is purchasing properties under LLC, and the IRS is frowned upon that. I can tell you right off the bat. So you just want to make sure that you're not buying, you don't have 10 LLCs, 10 different companies. It's not.
So Nana, my father has all of his properties as separate LLCs, but they're all under one umbrella corp.
Exactly. So
the corporation owns 5 LLCs, and he's an employee of the corporation.
Exactly.
His tax guy is amazing.
Yeah, exactly. That is brilliant, because guess what? The thing about the LLC is that a corporation is that it doesn't have to be a person. It can be an entity. It can be a corporation that owns another corporation. And the great thing about the LLC is that you only have to report your profit and loss. Once you have an S corp, now you have to start produce your balance sheet, your P&L, and your owner's equity, right? So let's just make sure that we know what the requirements are come tax time.
And then last thing, can you guys talk about the insurance? With the bank require the LLC to have insurance, and also the homeowner that's living in that property who's signing the mortgage, the mortgage as the house is being purchased, to have insurance as well?
John, I'll let you go. What I know is that from what my clients have said, that the bank will require that. But I don't know if you've seen anything different, John, Damaris.
I haven't. That's a question we would have to ask a bank directly. We are a CDFI. We don't necessarily delve into home mortgages. We do mostly business lending.
But we have, if you email me, I can connect you with the mortgage lender at 2 or 3 banks.
To answer Javon's question, listen, my dad keeps his business to his chest. He doesn't really let me access that. So I can't, I don't know. I don't know his tax guy. I wish I knew his tax guy. It's one thing about us Caribbeans, like our parents are like, figure it out yourself. We're not going to help you. So, I mean, I don't know. I learned by watching, and
or they'll pass it once they retire and they're done, then they'll give it to you.
Oh, I asked him that, Ms. Lore. My father said, I retired 15 years ago, son. What are you talking about? His plan is to sell all of his property and move to the Dominican Republic. I'm like, Dad, what? Huh? Legacy, wealth building. What? Let's go through this. Anyway, I've got 12 responses to the form. There are 34 people in this room. So that means that 22 people have not filled out the inquiry form. If you want a free one-on-one 30-minute consultation with a CPA, please fill out the form. If you're having issues, please let me know. I will figure it out and make sure that you're able to fill out the form. Nana, you are way over your time, man. I really appreciate you. I will stay on personally to make sure everybody fills out the form.
I just had one question. First, I did want to congratulate you guys because this was like a beautiful experience. Myself, I'm a college student, so I'm still kind of learning like the ins and outs and, you know, growing my mindset and growing, you know, my intellect and my intelligence with these sort of things. One question I did have before I go, if I'm able to get the presentation from email from someone, I'm not sure.
So Benjamin, here's what we're gonna do. Okay, everybody who was on the call today had to register and log in through Zoom. I have everybody's email, phone number, and business name. And what I'll do is I will share Nana's presentation, and then our communications person is going to take this video, do some minor edits, put it up on YouTube, and we will send the link out to everybody who came today to today's meeting, okay?
All right, thank you so much. You guys have a great one.
The most important thing is that you guys fill out the form so that you can get access to this free, no charge consultation, 30 minutes with a CPA that's specific to your needs. Nana, once again,
John,
yes, Dahlia.
thank you. You didn't answer my question.
I apologize. Go ahead.
Nana, so I do have a business account, but most of my clients pay me through Zelle, and you know, Zelle is through the personal account, right? I try to transfer the payments like once a week, but am I intermingling the accounts?
If you keep track of it, that's fine. But one of the things that I'm going to say right off the back is that you can also create a Zelle account for a business account through Zelle, right?
That's recent though, Nana. I just
That's
got
recent.
Wells Fargo just
Most
reached
banks
out
are
to me.
just recent, yeah.
Yeah,
But what you
Capital
do-
One doesn't.
Yeah, okay, that's yeah, you can do that. That's fine. Just make sure that at any time that you're getting the money, you put in. One of the things that I'm going to say right off the back is that you lose the description of the transaction when you do that. So make sure that
That's it, because for me, it just comes up as a transfer rather than as.
exactly. So make sure that as you're putting the Zelle, you know, you go in there, you're putting it, you're logging somewhere that, you know, payment from this customer for this amount. You need to do that manually because Zelle is not going to give you that information.
Thank you.
Okay.
All right. If there are no more questions for Nana, I am going to let the man go in peace. And I would like everyone here to please fill out the form so that you guys can get access. Nana, you are the best.
Thank you very much. I always enjoy working with BOC. You and Damaris, you guys have been great, and I love what you do for the community. And do fill out the one-on-one. I can tell you from experience that I've seen people that have taken advantage of that started from no business to a very good business. So
hold on, Nana. One second. Lisa Watkins, did you have a question? Lisa? Which software better, is Wave or QuickBooks or for a consultancy?
I like QuickBooks. You know,
Everyone loves
honestly,
QuickBooks.
it's you pay a little for it, but it's I'll tell you right off the back.
Lisa, did you have a question? Lisa Watkins? No? Okay. So I'm gonna stick around until I get everybody to fill out this form. Okay. Nana, thank you so much. I appreciate you giving us 30 minutes more of your time. You've been amazing.
Thank you. It's always fun coming on this call. Take care, everybody. Bye-bye.
All right. Once again, please fill out the form so that you guys can access a free one-on-one with a CPA specific to your needs. Okay, I'm going to continue to send the form to everybody. Please fill out the form. Martine, we did get yours. We did get yours, Martine.
Thanks, John.
No problem. No problem. Let me check how many people have filled it out now. I have 22. Oh, wow. Okay. There we go.
John?
Yes, Katrina.
Yes. How do we get the information in reference to the HBC Bank?
Oh, so my partner Damaris, she is going to get the email list after this meeting. I'm going to send it to her, and she's going to send out a flyer with all the information you need with regards to HSBC and getting that secured credit card. The program is ending soon. It's a very useful program. We want to make sure that people access it. I think it's ending in like 10 days. So let's get it out there, okay?
Thank you. And one last question. How long before they review your credit to refund you your deposit and to turn it over to a regular credit card?
So what happens is that you put in 500, they put in 500, and
Right.
then it all becomes yours. And it's a secured credit card for, I think, a year. And then after that year, it's all yours. And you can take the 1,000 out but the person who would know more about that is the person that Damaris will refer you to. You can ask that question to them. They're the ones in charge of that program. I think it's Renee at our organization, but I'm not sure.
Okay, thank you. That's totally cool. You gain an extra 500 just from opening up this account.
Right. But you won't
Okay.
see it. You won't see that full 500 until, later on.
Right after you pay it off and a year later and stuff. Yeah.
Well,
I've done secured credit before.
Right. So what it is that you're using a credit card, and then so the deal with credit is you want to use it and pay it off to zero every month. Like me personally, I don't use cash. I put everything on the credit card, and then at the end of the month, whatever the bill is, I pay that off to zero. What ends up happening is that I'm really, really careful about my spending because I know how much I'm making every month, and I make sure I don't go over that. And I end up saving money that way. And
Right.
I get to know how much it costs to run me as a business, me as a person, me and my family. Like I know exactly how much it costs to run that because of this.
Okay, I just wanted to know because I have excellent credit. I just wanted to do a business
credit card. Yes, it's really important. We did a seminar on business credit the other day from my Ascend group, and it's very different. Setting up business credit is very different.
Thank you for that. I have a question. I've been reluctant to apply for like the PPE and the EIDL. I did that advance, but I know now they've increased the amount to $2 million and all of that. And I do want to scale my business and really like sort of like invest in it. So based on what Nana was saying in terms of the accounting and the loan options, I want more information about that in terms of how to proceed with that. I do believe someone, when I asked the question, commented in the chat box, but are you guys still doing that? Because I know there was they stopped it and then you guys weren't doing it. So are you still assisting with the EIDL loans?
Yes, we're still assisting with the EIDL loans. If you email me, I will be able to refer you to someone in our organization who focuses directly on that, and we can work on that. Martine, the program by HSBC, it's not my deadline, it's their deadline. There's nothing I can do about that. Fatima, I have your form, so if you're there, you can go. Oh wait, is it Fatima Abarca or Fatima Murray? Because there's two Fatimas.
Fatima Murray.
Fatima Abarca. Thank you for that. I appreciate it.
Let me make sure that I have both Fatimas because there's two Fatimas.
Fatima Murray is me, LifeBridge.
All right, so let me see who's there. It's gonna take a second, everybody. So Fatima Murray, I have you.
Thank you.
And Fatima Abarca, I have you too. Okay.
Excellent. Thank you so much for everything.
No problem. Lisa Watkins, EIDL. I don't have a form for that. You would have to just email me. I'll put the email in the chat. Just email me and say you are looking to apply for the EIDL and need assistance. I will refer you to someone on our team that will do that. Chantel, let me check. Okay, let me see. Chantel, where are you, Chantel? Dimitri, Jennifer, Dahlia, Digna, Danielle, Katrina, Joanne, Dochi, Sabrina, Crystal. Chantel, got you.
It's Jacqueline. Can you hear me?
Jacqueline Gaskin. Okay,
Yeah,
hold on one
I
second.
didn't know if you got mine. Thank you.
I have over 25 of them now, so this is great. Jacqueline. Actually, let me just pull it up here this way. Yes. Allow me to look at it really quickly. All right, Jacqueline. Jacqueline, do you spell it with a K or with a C?
C.
Okay, one second. I got you, Jacqueline.
Okay, John, really quickly.
Yes.
It's a mess what's going on with me right now.
Hold on one second, Jacqueline. Lisa, I did get you. Lisa Watkins, I have you. Go ahead,
John,
Jacqueline.
do you have mine?
Yeah.
Yes, Dahlia, I have yours. Jacqueline, go ahead.
Yeah, I need a lot of help, and I don't even know where to get started. One thing I know is I have issues with the taxes, and I'm trying to. I need to first of all do that, and then from there continue. So, I'm doing everything from home. I originated as co-op. Actually, I came right out of the space where you are at GWC. So I was dealing with the person that was there at the time. I've done some workshop with BOC in Brooklyn, but I'm really out of touch and I really need to get reconnected and really get this business part of this business going. I'm
So what kind
creating
of business is it? I'm sorry.
handcrafted jewelry.
Okay.
I have a lot of inventory. I'm not making any money. I'm just pouring in my own money, and I've been doing that for a while, but I really needed to be a business. So I'm a co-op with one person. So, it's like right there, I'm out of the box with that. But originally it was 2 of us, but it's just me legally now.
Okay, so hold on one second, Jackie, because I'm trying to answer everybody too. Let me see. Erica McDonald, I have you. Javon, there is a deadline. I'm not the person in charge of that program. So like I said, what I'm going to do is right after this, I'm going to give the list of emails to my colleague Damaris, who will refer you to the person who is in charge of it. Okay. So Jacqueline, so what kind of tax issues do you have?
I haven't filed them.
Okay. So when you fill out the survey, when you filled out the survey and we asked specifically to detail what your needs are, did you state that in there?
Yes. Yes, I did.
Okay, so what we're going to do is we're going to go through our group of accountants that we work with, and we'll find the best one for you to help you with that particular issue. Okay.
Okay.
Once you've taken care of that, then we can start talking about other things that we can reach.
Okay.
All right.
And one of the issues that I had with the bank account, you know, because I really want to join the Brooklyn co-op, but honestly, I can't afford the fee every month. That's the problem. So that's why I haven't opened a business account.
Ms. Laura, I have you, by the way. So you can't open up a business account because you can't afford the fee.
The monthly fee, yeah.
For a business account.
Yes.
Okay. So at Wells Fargo, if I have a business account and I keep it over $500, they don't charge me a fee.
Okay.
But that's Wells Fargo. What I would do is I would try to search for a bank. I would go to all the banks and I would ask them questions like, do you have fees? Do you have any restrictions? What are they? And I would find out which one was the best one for me, and I would open up the account there. Right.
Okay.
So that's what I would try to do. Basically, I know that I paid $500 for a business account. That's what I did, because I'm never taking that $500 out.
Okay.
But it allows me to have my business account so that I can run transactions through it, put money into my business, and manage it there. So whenever I look at my business account, I just see the number and I subtract $500 and know that's how much I have.
So when you say 500, that was your initial
that was my
amount to open it?
Right. If it drops,
no. I don't have a problem with that. I have a problem with the ongoing fee.
Well,
you know,
no. Well, that's what I'm saying. There's no ongoing fee as long as I keep it at 500.
Okay. Yeah, because
the minute
they wanted more.
The minute I drop under $500, let's say it's $499, they're going to charge me a fee. So I just make sure I keep it at 500. Crystal Lore, I have you. You can rest assured that I have you on our list. Thank you.
Okay.
So that's just all I try to do to avoid the fee.
Okay, that makes sense. Yeah, I understand. I do that with my personal. So I have like a budget account. I gotta either do a direct deposit or have a certain amount. I understand.
Jackie, hold on 1 second.
Sure.
Katrina McLeod, if you want to unmute yourself, you can talk to her directly. She says she knows. She knows. Hold on 1 second. She knows banks with no fees and no minimums for a business account. Katrina, speak on that, please, because that could be information everybody can share.
So, Jacqueline, you're here in Brooklyn, right?
Yes.
Okay, so if you go downtown to Flushing Bank.
Okay.
Flushing Bank
that's on Montague Street?
Yes.
Okay, I was right there.
Yeah, Flushing
Katrina,
Bank is right there. Yes.
Do you have a business banker that you work with that you could say, hey, tell this person that I sent you and they'll help you?
No, unfortunately, I don't. They wouldn't take me because of one of my businesses. So the bank doesn't take clients who sell certain things.
Okay, I understand. Yeah. No problem.
Right. So, but I'm trying to figure out a way around that though. But
that's a discussion for another time, Katrina.
Yeah. So Jacqueline, yeah, if you go to Flushing Bank, I've sent so many people to Flushing Bank and I don't even have an account with them. But you don't
Okay.
need to have
Sounds
a
like you need a
minimum.
referral fee.
I know. You don't need to
Yeah.
have a minimum. You just open up, unless they've changed things over the
Mhm.
year or two. They're the
Mhm.
only local bank that actually doesn't require minimums. They're very good with supporting small businesses.